once you have investors, it's no longer your money. This is a weird kind of paradox that we're going to experience. And we have a lot of founders, Will, that are raising money. And now, rightfully so, they haven't really thought through what happens when that check hits the bank. But let's walk through, why do we need to be warned about investors? When you get it, it's no longer your money.
Right. Well, here's what I need you to really understand. I need you to understand that when you take on investor money, generally speaking, from that point forward, you no longer have carte blanche in how money comes back to you. Right. Whether it's, in many cases, the raise that you're going to get next year, or certainly any kind of distributions that you may take out of the company. And I've seen founders, some well-known founders, in fact, that I've talked to over the years. I'll give you an example. I had a great founder friend of mine who had only raised $800K. He grew his company, and at one point, he had like $6 million in the bank of profit.
Wow. Okay? Nice.
Right. And he was like, what can I do with that money? That's your money. He's like, no, it's not, because the investors put money in like 8 years ago. And I was like, no, that's actually, like, look at the cap table. You look at your operating agreement, like that is actually your money. Now, what I'm trying to say is usually it doesn't look like that. Like, I have so much money I don't know what to do with, right? A lot of times it looks more like, hey, this business is now throwing off $300,000 in profit a year. Can I take some of that? The answer is usually no, not until you return all the money that you gave to those investors. And a lot of people don't understand that, because the idea was we're going to put money into this company and you're going to have, hopefully some sort of big exit in a single liquidity event where we're going to give all the money back. Investments aren't really designed in most cases to just create a somewhat profitable business that sends checks out every year.
Especially startup businesses. They've got different goals. Well, my version of this story is we raised capital. So I think we raised I went out and I crowdfunded. It was reward crowdfunding. And we did about $45,000, $50,000. Then we raised another $200,000. So we had about $250,000. My co-founders did not perform, one in particular. And it was a really tough one. In fact, it was the divorce that drove me to come listen to Startup Therapy and then come, join us here, right? And so I went out and I said, I need to go generate the money. So I was the CEO and they needed money and I didn't need money. I was in a thankful position to do that. And so I thought I was doing the noble thing and I paid myself $1 as a CEO.
Never see that money again.
I went and consulted and I brought in money and I was the biggest breadwinner in the company while everybody was kind of spinning their wheels. And I was single-handedly holding up and I said, you know what? I think I now can take some off the table or I need some. And the investor said, no, you agreed to generate all this revenue and this is what it is. And that's really our money. This is how we're going to protect our investment. And furthermore, everything that I did when the company broke up, all the IP, everything, they were like, that's all ours. And I walked away with literally nothing except a bad taste in my mouth, even though had I done it all for myself, say I was a solopreneur and things like that, I would have been rolling in the cash, Will. Yeah, but 100%. It didn't happen. It was not my money.
And what's crazy is even a small investor, right? An investor, if you took $100,000 from years ago, you still have what's considered a fiduciary duty back to that person.
Exactly.
To either make them whole or what have you, or at the very least, not look like you're draining all the money out of the company for your own benefit, at the expense of the company would be the best way to say it. And it's interesting because you only need one or two people that can hold up that flag to say that you're breaking fiduciary duty, which is kind of a broad concept. But let me give you some examples of where things like that are a problem. Ed, you see a lot of people who put their own money into a company, right? So let's say you and I start a company and we both put in $100,000 of our savings into this company. And then we raise some money from investors and we're like, hey, when do we get that $100,000 back? Never, ever. You're never getting it back. Unless the company sells, you're never going to get it back. Or this is kind of parroting what you said. For the first couple of years, we didn't pay ourselves. Then we paid ourselves like a third of what we'd normally make in the market. And now we're at 60% of what we'd make in the market. When do we get whole for all that money we lost?
Exactly.
Never, ever. No one cares, and no one will ever come to you and offer to pay that back.
And when I ended up in a dispute, and it was a really ugly divorce, as I said, we had a chairman, and I went through everything, and they said, okay, now go and put all together, all the money that you spent, this and that, all together. And I went and did that auditing. Well, I moved to China. I lived off my personal expenses, credit cards, paid interest, this and that, just to make that startup work. And I got zero credit for all of that. So reality happens.
I learned this the hard way because like the fourth or fifth startup I did, I put a substantial amount of my own money, like very quickly, like maybe $250,000, something like that in the company. And then we ended up raising money very quickly. And so I thought like there was some sort of IOU situation that I'd be involved with. And because we raised on very favorable terms, a very friendly investor, all those good things. When I brought it up, I wasn't a jerk about it. I was just being friendly about it. I was like, I just need to know how to account for this money. And they said, it's already accounted for. Like, what do you mean? Cap table, that's your equity.
Exactly.
Right? They basically said, what you own in the company, that's what it cost you, right?
Yep.
That was it. End of conversation, never came up again.
Oh my word. Sometimes I feel so bad to have this conversation with founders, but it's a necessary conversation. Will, then how do we mitigate this hard truth that we're going to experience? What are some things that now you're advising founders to actually think about or potentially do to address this potential huge albatross that's going to be hanging over everybody's necks?
I actually get this quite a bit. I've got a lot of founder friends that'll come to me and they'll say, hey man, I'm on year 8 of this business. We raised some venture, maybe a few $1,000,000 over the course of years. And it's just not, it's not going to be a venture exit. It's a good business, right? Maybe generating $4 million a year of income, total revenue, and maybe $200,000 or $300,000 of profit. Okay. I'm still getting paid next to nothing. And the amount of money I had foregone to do this is insane at this. So their question becomes, what do I do here? And I remind them, you can go back and renegotiate your deal, right? And we talk about, how to create that leverage, et cetera, but you are not forever consigned to a deal, right? This isn't an indentured servitude of startups, right? You are a free person and you can go back to your board and say, this is what I want the new deal to be. And they're free to tell you no. But the worst thing you could do is say nothing and just consign yourself to that fate.
And do everything you can to get that leverage, as you say, by performing. Probably one founder that I admire, I know Elon Musk has done this with, I'm going to perform and I want my compensation. Yeah. And not big a fan. But I do respect the way Mark Zuckerberg did it because he, even though he doesn't own the majority of his company, he still owns quite a bit. He's got a lot of control. He's still the boss. And he just constantly went back and he negotiated with the board and, figured that out. And so I agree with you. It's okay to talk about it, be open. But the other thing that I'm advising founders, when you're going out and raising money, everybody, go in with eyes wide open. Hope for the best, plan for the worst, have these brutal conversations with us that we're going to tell you because, well, I can't think of any other place where two dudes, founders, are so openly talking about their nightmares that they've experienced. But that's what we want to do for all of you out there.
Absolutely. Absolutely.